Hi there, and welcome to this video. In this video I'm going to demonstrate how you may calculate an approximation for the repricing model for your bank. To start with, you need to find the appropriate data, and I have an example from 2023 Barclays annual report. So you're looking for a table that looks similar to this, which breaks down contractual maturity by different time horizons for both assets and liabilities. And as well as this, you may need to find some other information such as the bank's net interest margin. And that is the average margin it makes between assets and liabilities. And in Barclays' case, it provides this information. Now the first step is to extract this table into Excel. If you have access to a Bloomberg terminal, I recommend that you search Barclays. You try to go to the company filings function, which is CF, which has now changed its name to the document search, DS, but if you use DS to start with, it gives you annual reports for every company. Thus, I recommend search for your bank, then type in CF company filings. Then, when you have the annual report, go to this same page as you can see on my screen now, and then in the top right hand corner, there should be an extract button to click on. Or on the left hand side on CF function, there's a drop down box to export, and you can export the table in view. And when you do that, it should produce a table that looks like this from the annual report. As you'll notice, this is quite generic and the cells are classed as general, so you may need to change the cells into numbers and transform the data a little bit. Now when you have the data and you've transformed it into numbers, then let's start making the repricing model. Now first of all, this is a model that requires rate-sensitive assets, rate-sensitive liabilities. And it looks at cash flow, not nominal amounts of contractual requirements. So firstly, we need to think what is rate sensitive and what is not. Now that is hard to say from a balance sheet view because some items will be fixed, some will be variable within the same cell. We don't know, and we just have to make an assumption to say what we keep and what we do not keep. Some simple examples may be if your bank says non-financial assets or non-financial liabilities, of course remove them because they're non-financial. If you were to delete something else, for instance trading derivatives or amount for the trading portfolio, make sure you do that for both sides of the balance sheet. Other than that, you can use an approximation and keep items or just assume that they are rate sensitive. And the next step is to change the contractual requirement into cash flow. And how do we do that? And what do we assume the cash flow yield is per each nominal amount? And again, this is where we have to use a number of assumptions. And for this, I'm going to use the UK yield curve on the assumption that for liabilities, Barclays pays out the yield curve rate, and then for assets, it receives the yield curve rate plus its net interest margin, which we found earlier. Now, yes, this assumption is potentially an over-exaggeration. For example, customer deposits in the liability side. Do we really think that for less than 1 month, the yield curve is suggesting 4.49%? Do we really expect Barclays to give its customers 4.49% on customer deposits? Similarly, on the asset side, with deposits with the central bank, do you really think the central bank is going to pay out nearly 8% on these deposits to Barclays? So for some items like that, you may want to approximate or suggest something different. And as you can see, I've simulated the yield curve for liabilities across the top here, and I've added the net interest margin for assets. And then when we've done that, we need to convert these into cash flows using the percentages, which I've done here. So I have times, as you see, if we look simply at the cash and balance with the central bank, that before was highlighted here. I've essentially times this number by 8% to calculate what the cash flow may be. Now, as I just noted, that is a pretty stark approximation because I don't believe the central bank would pay 8% on such balances. But again, you can tweak that to something more believable. And you simply do that for all of the cash flows on the asset and liability side. Then you total up the columns to get the total rate sensitive assets and the total rate sensitive liabilities. And then finally, you can work out the repricing model gap by using the calculation rate sensitive assets minus rate sensitive liabilities along the bottom here. And as you will notice, the majority of the repricing model in this approximated example is positive, except from the period between 3 months to 6 months. And the most positive, unsurprisingly, is the longer dated, the longest dated bucket. And the reason for that is, on the asset side, this will contain the mortgage book, which is usually the biggest income for a consumer bank. I hope you found this quick tutorial helpful.